Leeds, HSBC, TSB and Virgin are all reducing mortgage rates again. But is this just a summer sale or the last big drop before things reverse? So this week we've seen fresh rate cuts from some of the bigger players in the market, some huge affordability boosts that could help thousands more home buyers, and a surprise update from Metro Bank that landlords are gonna love. Plus, we've got bold new house price predictions that I personally think are wildly optimistic, but stay listening to the end for that one. So let's start with the bit that everybody always wants to know about, and that's the lender rate reductions. So this week, Leeds Building Society kicked things off with reductions of up to 0.3% on selected residential rates. Virgin Money followed suit by trimming rates across their entire residential fixed rate range as well. Clydesdale Bank also made some moves up to 0.22%. HSBC cut both residential and buy-to-let deals. And lastly, TSB also reduced some selected fixed rates. Now, there were other smaller lenders that were also reducing rates, but those are the main ones to think about. So now we've had 3 solid weeks of lender rate reductions, which clearly shows that we are still in the middle of a rate war. But the question is, are we nearing to the end? Because it certainly does look like these rate cuts are starting to slow down. And I think what we're probably going to see now is lenders tweaking rates, which is more about managing their workloads than it is actually about offering cheaper rates to clients. But I've got a question for you. For those of you that need a mortgage at the moment or are thinking about getting one in the not too distant future, be it, purchasing or remortgaging, are you holding out for more rate cuts? Or would you be happy to dive right in and fix right now? Please let me know in the comments. Now, moving on to something that hasn't had as many headlines this week, but is equally big news for people that are looking to purchase a property. Gen H has just increased how much they will lend, boosting affordability by up to 22%. And that means they can now help up to 12% more borrowers get on the property ladder. So if you're a first-time buyer struggling with income multiples, this kind of criteria change can make all the difference. We're seeing a quiet revolution across all lenders, easing affordability rules, nudging up income multiples, and helping more buyers qualify for mortgages at today's increased property prices. Now, I mentioned this last week, but I just want to revisit it. With more lenders offering income multiples in excess of 6 times your annual income, I'd like to know, if you were offered a mortgage where they were using 6 times your annual income, would you take it? Or would you play it safe and borrow less to manage your affordability? Please do let me know your thoughts in the comments below, because things like this, I can feed your comments back to the lenders and it can help to shape mortgage products of the future. Now, for the landlords amongst you, Metro Bank has just launched into the HMO and multi-unit market for both personal and limited company borrowers. That's a strong addition to the buy-to-let lending space, and it shows that competition in this specialist market is definitely heating up. And sticking with landlords just for a moment, the latest figures from UK Finance that we saw this week show that just over 58,000 new buy-to-let loans were advanced in Q1 of this year, and they were worth £10.5 billion. That's up nearly 47% by value compared to Q1 last year. The average rental yield is now at 6.94%, and the average buy-to-let interest rate has fallen to 4.99, 41 basis points lower than this time last year. So why is this happening? Well, I think we're starting to see a shift. Smaller, accidental landlords are exiting the market, but experienced landlords are expanding, taking advantage of lower rates and better rental incomes. But for those of you that are in this space, I'd love to hear your thoughts. Are you exiting the market or are you expanding your portfolios? And what do you think of the future of buy-to-let? Now, moving on to the wider economy. Retail sales data released this morning shows an increase of 0.9% in June, following a gloomy May where they dropped 2.8%. Now, I think that this is down to the weather finally behaving. But let's wait for Rachel and the Treasury team to claim that it's all thanks to their policies, because we know how they love to do that, don't they? Now, lastly, moving on to house prices. There are growing forecasts that estimate prices could increase over the next 5 years by 25%. Now, that's roughly 5% each year over the next 5 years, which is being driven by easing affordability, growing demand, and of course, a persistent lack of supply. Now, honestly, I think 25% is a bit optimistic, but I'd love to know, do you agree? Is 25% too bullish? Or could we see that kind of growth if the market remains competitive. So here's my roundup and my personal take on this news this week. Fixed rates are still dropping, lenders are getting more generous with what they will offer you, landlords are finding better returns, and affordability is quietly improving. But inflation is still lurking in the background, and we all know that swap rates can go up just as quick as they come down. Plus, we've got the Bank of England base rate decision at the beginning of August, and who knows what that's going to be. So if you've got any thoughts or questions on this video, please do drop them in the comments. I do read and reply to every single one of them. And if you have found this video useful, please do give it a thumbs up, hit subscribe, and follow me for next week's update. Because the market's moving fast, and I will just be here every week making sense of it for you. Take care.